Welcome, guys. So, yeah, before we begin this episode, I want to introduce someone you'll be hearing from throughout the series. His name is the Liquidity. He's been trading for over 4 years and he understands these concepts at a very real, practical level. So, from time to time, he'll take the lead on certain episodes, and today is one of them. So, guys, don't worry, you are in good hands. And he studies ICT deeply, he respects the process, and he sees the narrative the same way we teach it here. So settle in, guys, take notes, and enjoy this one.
Welcome to episode 2 of the two-part series on understanding liquidity, the key to ICT concepts. My name is the Liquidity, and I will be assisting Dr. Trades in this lecture series where we cover various ICT concepts. Just a little bit of a background from myself. I've been studying ICT concepts for over 4 years, and I've gleaned various gems um, throughout the course of those 4 years. I am grateful for this opportunity to share this with you, and I hope you find this insightful. So, without further ado, let's commence our lecture.
Before we move into the deeper concepts, I want to frame what this part of the lesson is designed to expand on. First, we're building on the foundation covered in part 1. You already understand the basics of liquidity, what it is, how it forms, and why price seeks it. Everything we cover now rests on that groundwork. Secondly, we're going to deepen our understanding of liquidity. This means looking at how liquidity behaves inside a range, how it creates opportunities, and how it shapes the path the algorithm chooses. Thirdly, we'll introduce the mechanics behind low resistance liquidity and high resistance liquidity run signatures. Low resistance liquidity run signatures and high resistance liquidity run signatures explain the efficiency of movement, the clean side of the market, the protected side after a sweep. Understanding this will help you see why price favors certain directions. Fourth, we'll break down internal and external range liquidity, or for short, IRL and ERL. Internal liquidity is consumed inside the range, and external liquidity is targeted waiting outside of it. This distinction guides the entire delivery process. And finally, we will be establishing the full liquidity narrative. By connecting these pieces, failure swings, internal cleanup, low resistance liquidity runs, high resistance liquidity runs, and the external draw, you'll begin to see the market as a structured, intentional delivery model and not random movement.
So, before we continue with a deeper dive into liquidity concepts, I think it's worth noting that we should first cover some dealing range theory. So, what is a dealing range? The market consists of various market profiles, whether it's consolidation, reversal, retracement, and expansion. When we put these various market profiles together, regardless of the time frame, we would find a dealing range. Now, a dealing range, in simplified terms, is defined as a high and a low, where both the high and the low of this range um, has taken both sell side liquidity as well as buy side liquidity. Now, inside that range, you would find typically two things. Number one, internal range liquidity in the forms of highs and lows, or minor highs and lows, which lie inside the dealing range, as well as internal range inefficiencies, which in simple terms is just your fair value gaps. So price would seek to consume internal range liquidity or rebalance internal range inefficiencies, which is fair value gaps, before heading towards the external range liquidity, which is simply liquidity lying outside of the dealing range. Now, when you look at dealing range theory, as well as your PD arrays and your understanding of liquidity, you realize that dealing range theory provides the framework that guides market delivery and is a great tool to simplify your analysis. Now, without further ado, let's look at an example of a dealing range. Right, as you can see here, this is the pound dollar. It's a daily chart. And what we can see is price head down, taking out a sell side liquidity pool. Price then heads up, leaving a buy side inefficiency, also known as a bullish fair value gap. Price then taps into that fair value gap and heads higher, taking out a buy side liquidity pool. Note um, this high right here and this low would not necessarily constitute a dealing range on its own up until buy side liquidity is taken. Notice there's no high here on the daily chart that this high is swept to make it its own dealing range. Therefore, for this to be considered a valid dealing range, this buy side liquidity pool is first engineered, drops lower into this fair value gap, and then takes out that high. Therefore, from this high to that low, this would be our dealing range. Now, just for a second, forget the price action which follows here. Let's look at this range only. What do we see inside this dealing range? We see this low which formed representing sell side liquidity, but in the context of a dealing range, this is your internal range liquidity, also known as IRL. And we also have our buy side inefficiency or daily fair value gap. Now, as you can see, now that we return to the subsequent price action to this high forming, you see price delving deeper into the dealing range, and it takes out the internal range liquidity as well as rebalances this buy side inefficiency. It digs into that fair value gap. And note when we grade our dealing range from this high to this low in quadrants, notice how price action reverses around that 25% of the dealing range. We'll delve deeper into dealing range theory in a later course, but just note that these levels, these grading levels, they're very important in terms of not just grading the dealing range, but using them as a confluence in alignment with your PD arrays when trying to catch the reversal. So yes, this is the example on the dealing range. And notice once price taps in to that dealing range grade, as well as after taking internal range liquidity and internal range inefficiency, price then heads upwards to take out this dealing range high, which also is your external range liquidity. So that is your example of a dealing range. So once we cover dealing ranges, our next concept that we'll be covering is failure swings. So failure swings is one of the key signatures when assessing the various liquidity pools in your financial analysis. So what is a swing failure or a failure swing? A swing failure is a moving price action that fails to take a previous high or low. In a bullish scenario, imagine an uptrend. Price is trending up, creating higher highs and higher lows. We then see on the last retracement, price head higher. However, price fails to make a higher high and subsequently reverses to the downside. What you see there is price failing to tap into a buy side liquidity pool. And that may be simple in appearance. However, it is a key algorithmic signature when identifying vacant liquidity pools which the market or the algorithm has yet to tap into and can serve as a potential draw on liquidity. The opposite applies as well. The same applies vice versa in a sell side scenario where price is making lower lows and lower highs in a downtrend. Price then expands lower but fails to take the previous low and reverses to the upside, creating an untouched sell side liquidity pool. Again, this is a clear signature that sell side liquidity has not been touched and that the algorithm will later refer to this area in price for sell side delivery. Um, now, what the value that this will provide in our financial analysis is that it would provide us with what is called a low resistance liquidity run signature, whereby we have these failure swings and price appears to have reversed and taken the opposing liquidity. However, you soon find that once that program, I call it a manipulation program, has run its course, price shortly reverses and with much momentum goes and seeks out those failure swings, those relative equal highs, to give that delivery that it should have had, but it failed initially. So this is known as a low resistance liquidity run, and price action is very expansive once it targets that, and it gives very shallow retracement, should I say, when low resistance liquidity run signatures are targeted. Again, I think it would give much more value if I showed you an example. So as you can see here, we have one chart, but there are two examples. I do believe this is the gold chart on the 4-hour. We see price move up here, failing to take this high. Price then subsequently heads lower and makes another lower high. Notice we are failing to sweep buy side liquidity. Price then heads down and takes sell side liquidity. The market then starts to consolidate, but notice before we head up, we have another failure swing where price makes this high, fails to take this high, moves lower, again has another failure swing, and we continue to take a sell side liquidity pool. Notice when we take the sell side liquidity pool, the market fails to displace below this low that swept the sell side liquidity. The market then subsequently reverses and heads to the buy side and gives buy side delivery. Again, as I mentioned in the previous slide, notice how the market is moving in a expansive move compared to this downside delivery where price was relatively choppy and sideways, and you see that price has since expanded with momentum to the upside and has taken out these buy side liquidity pools. This is why we call it a low resistance liquidity run signature. Now I just want to address this piece of price action here below. Notice I've mentioned that price has failed to take this low that has swept sell side liquidity. And the terminology for this is known as a high resistance liquidity run signature. Why is it high resistance liquidity run signature? Because as you can see, there is great resistance in taking price action, in taking that low in price action. And therefore it can be seen as a protected stop. We cover high resistance liquidity run signatures as well as low resistance liquidity run signatures in greater detail in the following slides to come. Okay, so again, I think it would be good for us to reiterate the various characteristics of a low resistance liquidity run signature and a high resistance liquidity run signature. They are two sides of the same coin. Low resistance liquidity run signatures again are signified with failure swings. They represent untouched buy side or sell side liquidity pools with minimal opposing liquidity in the way. When price moves towards a liquidity pool, which represents a low resistance liquidity run signature, we see that price moves through it efficiently and with momentum, and it can be compared to a glide path toward external range liquidity. Now, conversely, high resistance liquidity run signatures represent liquidity that has already been swept, where the market has gone through a liquidity pool and has subsequently reversed through it. It is quite the opposite of low resistance liquidity run signatures, and it essentially it forms a protected side of the expansive move. We typically use high resistance liquidity run signatures for stop loss placement and invalidation points when we conduct our analysis. It is also a very helpful tool in confirming the market's intention after a liquidity pool has been swept. Again, just to solidify our understanding of low resistance liquidity run signatures as well as high resistance liquidity run signatures, I have drilled down into our example we've had in earlier slides. If you recall the dealing range slide that I've placed in earlier in this lecture, um, I've taken that dealing range and I've drilled it down to the 1 hour chart. So we can see how we can accumulate all the knowledge we've learned in this lecture and place it in one example. So as you can see, we have this dealing range high right here and the dealing range low right here. As you as you can see, before we reach below the equilibrium price point, price fails to take highs, representing failure swing patterns, or should I say failure swing signatures. So the market fails to take buy side liquidity and accumulates untouched buy side liquidity in this premium zone and drops lower, taking out internal range liquidity as well as rebalancing that daily fair value gap. We then see the market consolidate and head higher, but before we head high as the through move, we sweep a sell side liquidity pool and displace upwards, leaving us with a high resistance liquidity run signature. As you can see, the market does not return, the price does not return to this low up until it has taken out external range liquidity. Therefore, you can see once we are able to take the various elements of a dealing range and combine that with our understanding of liquidity and PD arrays, we are able to map out the market and use the dealing range as a framework for not just our entries, but seeing when the move is likely to occur and what needs to take place before our move can occur. So this is an example of high resistance liquidity run signatures paired with low resistance liquidity run signatures. So this brings us to the end of our two-part series on liquidity. I think it would be worthwhile just giving a recap of what we've covered in this lecture. So we've covered the completed full liquidity framework. We've shown you how internal range liquidity, external range liquidity, low resistance liquidity run signatures, and high resistance liquidity run signatures all operate within the context of a dealing range. This sets the foundation for the deeper delivery mechanics in price action, in algorithmic price action delivery. So in future lectures, we'll be giving you a more execution focused approach on applying these concepts and allow you to develop your own entry model while having the framework of what we taught you in this lecture to guide you. Again, just as an example, a hypothetical entry, which we'll cover in a later lecture. This is the same example I've covered in the previous slides. As you can see, we have our low resistance liquidity signature and a high resistance liquidity run signature in the contents of our dealing range. And you notice that this up close candle engulfs this down close candle, creating an order block. This is also known as a change in state of delivery. And what that means is it's an algorithmic signature that price wants to move higher, that the state of delivery has moved from sell side delivery to buy side delivery. That can be an entry confirmation. Now, we'll cover various entry confirmations or entry models in a later lecture, but we just want to indicate how you can use high resistance liquidity run signatures for stop loss placement, as well as low resistance liquidity run signatures for targets. As you can see, this yielded just roughly over a 2R trade. I think it's about 2.5R if I'm not mistaken. It's a very handsome trade, and it's very achievable once you understand the various contexts. Entry models is really the last piece in the puzzle in studying price action. All the groundwork needs to be done leading up to your entry, and pulling the trigger is the least of the effort that goes into price action analysis. So if you have enjoyed our video, please do leave a like, as this helps the channel grow, and it gives constructive feedback to us to know what works and what does not work. Please engage with us in the comment section. We do appreciate any feedback. um, the PDF slides to this lecture has been provided on our Discord channel, so please do join our Discord channel via the link in the description. Next week we will be covering uh, a lecture on sessions and how it behaves. This covers the New York session, London session, as well as the Asian session, and will give you key insights in how liquidity behaves around these sessions, and will allow you to truly understand what ICT means when it says time first, then price. I hope you find this lecture insightful, and until next time, happy trading.